Thank you very much. It's very nice to be here. What we're going to do is I'm going to ask the panelists to each introduce themselves, and then I'll give a quick set of slides, just setting an overview sort of for where things stand at the moment, and then we'll go into a panel discussion. So I'll turn to Allan and ask him to start.
Good morning, everybody. Thank you, Stephanie. Thanks for the invitation to speak here. My name is Allan Marchington. I'm Head of Life Sciences at ICG, Intermediate Capital Group, recently renamed ICG, actually. We're a FTSE 100 company based on the London Stock Exchange, an alternative asset manager with in total around $130 billion under management. We're one section of that. It's not all our capital to spend. We focus on clinical stage opportunities in therapeutics across UK, Europe, and the US.
Good morning, everyone. My name is Asun Monfort, and I work in HBM Partners. HBM is a Swiss healthcare investment fund. Our main vehicle is a 2 billion fund, and from this vehicle, we invest both private and publicly. I work on the private equity team, and we have a strong focus on clinical stage therapeutics.
Good morning, I'm Cindy Daniel, Head of Unit for Life Sciences and Healthcare Equity Investment with the EIF. So EIF is a subsidiary of the EIB Group, which invests in private equity and venture capital funds. We invest around 7 billion a year in European funds. And looking at our activity in life sciences, we've been active in the sector for the last 25 years. I've invested 5 billion there in 180 funds, and we invest around 800 million for 2025. That's our target.
Good morning. My name is Ina Prosser. I'm a partner with Fountain Healthcare Partners. We're a venture capital fund based in Dublin in Ireland, and we also have offices in New York. We've been investing since about 2008, and we're currently investing our fourth fund. Geographically, we have a concentration in Europe, but we can invest in the US. We mostly do private, but we can do public as well. Our bite size is up to about 20 million euros over the life of the venture. And we invest across biotech, medical devices, and particular interest in product-focused investments. Thank you.
Good morning, I'm Sam Fazeli from Bloomberg Intelligence. First, I want to say thank you to Stephanie to do pretty much 90%, 95, 100% of the work that you're going to see. We just sit here and talk about it. So a lot of work on her side. Thank you. I'm at Bloomberg Intelligence, one of the three research groups within Bloomberg, which we cover pretty much every asset class that exists, and write research and provide data and analytics on it. We are, if you're used to seeing sell-side research, we are not sell-side research. We don't provide opinions in terms of share price directions, but do pretty much everything else. And there are two other research groups within Bloomberg, which is Bloomberg Economics and Bloomberg New Energy Finance, that's focused on energy transition. We total around 850 people. Have been around 15 years ago. I joined Bloomberg now. Give it 2 more months. And I have another hat that I wear, which is healthcare, which is why I'm sitting here. And within that, we're developing a pharma-focused product, which some of you are going to get to see when we chat later today in our one-on-one meetings. If anyone else is interested, you can come over and have a chat to us.
Just a quick introduction. So Stephanie Léouzon, I've been a healthcare banker for over 35 years. At Stifel, which is a large investment bank headquartered in the US with offices across Europe. We're very busy on the fundraising side as well as on the M&A strategic side. Since September, we've raised over 1.6 billion in equity financing for the biotech sector, mostly in the US, and that included one IPO. So the first IPO in, I think, 7 months. So hopefully there'll be more to come. In the US, the Senate is there, thank you, in a stalemate in terms of spending proposals. Mostly at the moment, the sticking issue seems to be whether subsidies for Obamacare, which is also known as the Affordable Care Act, will be extended. And if they're not extended, the conversation that's happening is that the people who pay those premiums for their insurance the cost of that will sort of double. So that seems to be the last sort of sticking point, and that's causing a lot of issues for everybody. Why does this matter? Well, this is very interesting actually, because the Republicans do not want to extend the subsidies, and the Democrats are fighting to do that. But when you look at this map, the pink dots are the dots of Republican-held U.S. House districts, and the size of the dots indicate what percentage of people in those districts are enrolled in the Affordable Care Act or Obamacare. So it's kind of interesting that the Republicans are fighting to decrease these subsidies when actually, when you look at this chart, you see that a number of their districts in the House of Representatives have a large number of people that are relying on that. There'll be a number of implications which we can talk about of the shutdown, but one of them is that the FDA, for example, will stop accepting new drug submissions, will stop inspecting plants, et cetera. So there's a lot to talk about this morning. The other thing that we often talk about on the macro side has to do with interest rates. Why does that matter? Well, biotech in particular has a series of long-dated cash flows. If you look at that, the interest rate that you use as a discount rate really does matter. So biotech tends to do better in a lower interest rate environment. We have had, for the first time in a while, we had a rate cut more recently. One of the Fed governors has recently said that she's still focusing on inflation, and we're still a long ways to go in terms of reaching the target for inflation. We don't have the payroll data from last week because the government is shut down. So, there's usually a trade-off between inflation and payroll and employment. And so we're a little bit blind at the moment on the payroll side, but we do have an idea on inflation. So to be determined whether rates will continue to be cut or whether inflation, which might be starting to tick up, and some people say that's because of the tariffs in the US, to be determined where that all goes. However, all of that being said, we speak at this conference, twice a year, and sometimes we try hard to be optimistic and find encouraging things to say. Right now, we're actually in a very good environment. We've got, at the moment, expectations for falling rates to be determined. We have an M&A boom that's coming on, which I'll talk about. And in general, we have gone from, as one of my colleagues said, despondent days of darkness to talking about all the upside opportunities that there are in the space. So we're in a reasonable place in terms of biotech sentiment. We are expecting that to continue. Risk appetite is shifting into a risk-on kind of environment in the market. That's good for biotech. We've got a strong M&A market, which I'll talk about again in a minute. And even overall, more broadly, the S&P 500, the bigger market, hit an all-time high last week. So we see, kind of a positive environment at the moment. This is a very busy chart, but the XBI, which is the graph on the right, excuse me, closed above 100 last week on Friday, so up 11% in the last 2 weeks. Which is great. The VIX, which stands for Volatility Index, which is the chart in the middle at the top, is below 20. That's a nice environment. When you don't have a lot of volatility in the market, it's easier to finance biotech, and we tend to think of 20% as kind of a threshold below which it's easier to finance biotech. And then, as you can see in the bottom middle chart, interest rates are, on the lower side, those the low fours right now. So all in all, that's a pretty accommodating environment. This is just a global biotech. So this includes places like China, which is important, which you'll see in a minute. But in the last 6 months, the total enterprise value of biotech sector has been up over 100%, which is a great improvement from some of the past. China's done very well. I can't quite read the number here, 150% year to date. Interestingly, the US and Europe are both up about 18%, which is great. Sometimes there's a disconnect there, and it's nice to see that those are coming together. Interestingly, South Korea also on a boom at the moment. And very nice to see that the number of negative enterprise value companies has come down to a very low level. So this chart goes from bottom to top. So the most recent number is at the top. We've had negative enterprise value, for example, by the way, is when a company's market cap, the equity market value of the company is trading below its cash. So obviously that's never a good thing. It's nice to see this number coming down so low. We'll talk about this on the panel, but Pfizer's deal with the Trump administration is very interesting. They're talking about Trump RX. Pfizer's cutting prices. There's an opportunity for consumers to go direct to a website, which is I'm not sure functioning at the moment, but people have tried to find it, and we'll talk about the implication of that. Also, Pfizer, for example, has made a $70 billion pledge to expand its U.S. manufacturing and research and development. And in exchange for all of that, they get a 3-year grace period to exempt it from the national security tariffs. In terms of the capital markets, this is a chart that looks at different kinds of financings. The blue is venture privates. The orange is IPOs. The gray is equity follow-ons, and the yellow is private debt. Excuse me. So the number for 2025 on the far right is annualized. We've had this one IPO so far this year. That's the little orange sliver there. But as I mentioned earlier, we've had a very busy time in the follow-on market, and I'll go into a little bit more detail now. So we had the LB deal about a month ago, maybe, and they raised about, including the green shoe, around $325 million, but the IPO market is still slow, and with the government shutdown, there will be no more IPOs until the government reopens because there's no one you can file, but no one's there to read it. So we'll see what happens. Hopefully there'll be some buildup of appetite from investors looking for new IPOs while this quiet period goes on. The follow-on market has been, very, very busy, as we've seen, as the XBI has risen. It's been very much a question of, you get good news, your stock price goes up, you can finance, which is a change. A few months ago, you got good news, your stock price would go down. So this is a much more attractive environment. The debt placement market has also been very high, very strong this year. And venture equity seems to be coming back, venture private capital, as investors on the private side see more support from the market for things like IPOs. They seem to be more willing, and we'll ask some of our colleagues to make new investments rather than holding on to what they have for their own to support their own portfolios. In terms of M&A, September saw over $1 billion in M&A volume a day. That was $36 billion in deal announcements. This was the strongest month for M&A since Pfizer announced the purchase of Seagen. What's very interesting here as well is that there's no single large deal. The two largest transactions were the Genmab-Merus deal and the acquisition of STADA by CapVest. But those two deals don't even equal half of the M&A volume. So quite a big movement in M&A. If you extrapolate the volume sort of year to date, you see the second strongest M&A year since 2019. And again, there's been no kind of deals, let's say 15 billion and plus in terms of size. And as I think I mentioned, so what's really exciting about this is that, the dollar volume in the $1 to $20 billion category is what's driving this M&A volume. So that's really great to see because it kind of spreads things around. It's not just one deal that's kind of the anomaly or the outlier. And finally, just to end on a happy note, in Europe, we've had 3 great success stories this year, probably more, but these are the 3 that sort of stand out. Abivax, which you I'm sure know, is the Euronext and NASDAQ listed company focused, based in Paris, 5.8 billion market cap now, just announced some data on their ulcerative colitis drug. The share price was up 500%. They raised a very large amount of money, and it's been a great European success story. Maris, a Dutch company, also a NASDAQ listed, $7 billion market cap. That's today. So it's announced that Genmab is going to buy them for $8 billion, which was a 40% premium over their value the day before. And that again is for a late stage asset in head and neck cancer. And finally, Unicure, again a Dutch company, also listed in the US, about $3 billion, focused on hemophilia B gene therapy. They announced some remarkable data in Huntington's disease in September, and the share price went up 250%. They went and raised about $350 million on the back of that. So these are three great European success stories. So we just wanted to close the slides out with that and then head to the panel. What should we start with? Sam, do you want to talk about some of the macro things that are going on right now?
Yeah, sure. So let's pick up on interest rates. I think whether there is a blip in inflation or not with regards to tariff impact, I think our feeling is that at least our economists believe that that's unlikely to be sticky, because what the Fed worries about is sticky inflation. And in reality, they're more worried about, I think what drives the Fed in the US is more jobs market, which of course we don't have any view on now because there are no numbers. And you could wonder whether you would trust the numbers when you did see them because of the situation I'm sure you've all been following with the Bureau of Labor Statistics and what happened with with regards to the employees there who the administration did not like the numbers that they put out. So if job market is weak, even if inflation looks a little bit more punchy, which you could do in the third quarter, that is the quarter where you would expect the tariff impact to come in, then I think that most people believe that the interest rate cycle is still on a cutting cycle. So that would be good for us. I wager it's better for us more from a perspective of the cost of capital, not in terms of our companies, but in terms of the risk appetite of investors, where there is easy money to be made, even if you just park your money in a government bonds, then it's harder for investors to switch to investing in high-risk sectors. As interest rates go down, the risk appetite goes up. So that's, I think, where we would see more of an impact on biotech rather than our models and the way that we would put. I don't know if any of us would change our models and the discount rates we put in them, etc. So that's from an interest rate perspective. I'm still optimistic that would be a driver for the sector going another good few months. But of course, don't forget, we are dealing with an administration that is not necessarily easy to read from a day-to-day basis. So, and the other element, of course, is the overall negativity that there was a cloud that was over the entire sector, pharma, everybody, and you've seen all the share prices, not just of biotechs rising. Just as soon as Pfizer's deal was announced, everybody's share price went up. And it was another example of how the administration has been able to create so much noise that when pharma companies do something that's not actually a win, they're not in a particularly better place than they were a year ago, it's still celebrated, right? It's the same as Europe and the tariffs. We've all got, I'm sorry, I've had a cold the past few weeks, a few days. We started this time last year with no tariffs. Then everything looked terrible, and then we've ended up with 10, 15% tariffs, depending on what countries you're in, and we were going, oh, thank God for that. It's really quite crazy how we celebrate something that is not necessarily a win, but it's still a small lose. So pharma companies, we can debate whether that deal that Pfizer announced was a win, but certainly from a share price reaction and just getting rid of the uncertainty, it definitely was. Although I would wager, and I would love to have everybody else's view as to, has the uncertainty gone away? Do we know exactly what's going to happen? Is that enough, macro?
I think the answer is we don't actually know what's going to happen yet. But I should say, does anybody have any questions from the audience? We should start with that as well. I see, yes.
Because you mentioned the Pfizer agreement, do any of you have anything to say about the MFN? Because I was expecting last week or the week before that there was going to be an announcement on the U.S. policy, the new U.S. policy for the MFN, and that would have big implications for the European companies that are trying to get the new pharmaceutical legislation off the ground.
There was, just not much substance. So the few things that happened was there was a worry that the MFN would be very broadly based. It wasn't, in terms of what countries are used for reference. It did refer to new drug launches having to be priced at the most favored nation level. Again, the question there is, if that actually gets put through, then of course, one of the ways that I've characterized this event, the Pfizer administration TV show that you saw, is a win-win-lose. On the surface, it looks like the administration's got something that they can go and tell their voters about. Pharma has got rid of the, is it going to be 100% tariffs on the 1st of October or whatever, etc. And that's another win, so to speak. And of course, Europe potentially loses. And the way that this MFN could work is that if that it becomes a reality, then any new drug has to be launched in the US first. There's no question of bringing it somewhere else first, or even if their data is way ahead. So there's a loss. And whatever price they choose to launch it at, I want something that really shocked me earlier, a few weeks ago. There's a wonderful drug for non-muscle invasive bladder cancer called TAR-200 that Johnson & Johnson has developed. It's a device called a pretzel that's got gemcitabine in it. How long has gemcitabine been around as a drug? Years, right? And you insert it into the bladder. It forms a loop on itself that looks like a pretzel and elutes gemcitabine. It's a great, great device. It gives you great efficacy, really wonderful clinical data. How much would you say that's priced at? Only anybody who actually doesn't know the answer, please tell me. On an annual basis. What's that? Just someone shout out the number. A drug-eluting device in the bladder. Cost per annum, launch in the US. Anyone want to venture a guess? 100,000. That would be great, right? 700,000. Okay? So the issue we have here is that, let's say that's the right price. Johnson & Johnson's, is a formidable company and highly revered, but they have this price. Imagine Europe trying to then match to that, right? So it's going to be very difficult to see how this pans out. If J&J, as it's doing, launches in the US first, then what do we do in Europe? What's our issue here? Our issue is we treat everybody that should get treated, or our budgets will explode, or we restrict access, another lose. Or we don't allow it. We just say keep putting some gemcitabine in and shake the patient around, which is kind of what they do. Literally, for BCG, you need to move the patient around. So, enough. I hope that kind of answered your question. It's there.
Okay, anything else for the moment, or we can speak on the panel? When we had our prep call, we talked a lot about, I was interested to see those, the performance statistics for Chinese biotech. We talked a lot about the emergence of innovation in China. Do people have thoughts on that?
I'll give it a go. I think it's what an opportunity and what a threat for us all in this room, I guess, who are not dealing with China. I think the stories are true about Chinese companies working 24/7, 7 days a week, and really being innovative these days. And I think we're all seeing that. We're all looking at that. And I think, to some extent, from our perspective, we think we've got to embrace it. We've got to go there and live with it. It's not going away, but it's how do you adapt and how do you change to be able to change your behavior to be able to take those products and develop them in the West and really work with Chinese partners. I think they're hugely innovative and huge opportunity for us. I think one of the things that we're seeing as a first step is that every company we look at as an investment opportunity and it's in the clinic, we go and have a look around China, and generally you'll find similar products, similar stages, and perhaps better efficacy or better pharmacokinetics or whatever it is that you've always got to compare against. And it's just a blind spot for people that they're not seeing a lot of that. And so I think we've just got to be more aware to look at those companies and see what's available. But I think it's a tremendous opportunity, and it's going to be great for patients because there's a whole mass of people now who are extremely innovative, whereas previously it was more following rather than leading. And I think China's now leading in a lot of areas that we've got to deal with.
From a VC perspective, some of the principles we would use in any territory apply. If you don't have boots on the ground and you don't have people to do diligence, it's such an enormous territory to cover. So we haven't done anything specifically with any asset relocated or acquired, but we are very vigilant about what's happening there. But I think where pharma have deep relationships with certain companies, that can give, as it would in India and other markets, a certain amount of oversight and inferred due diligence that they have been through a lot of the processes. So, we live and die by the diligence we do on new investments. So I think that holds true. So being sure you know what you are buying and being able to verify it is one of the things. But you cannot beat the speed, the efficiency, the amount of money, and the cost. And even certainly with WuXi and groups like that, nobody can beat them in terms of the cost of goods and the timelines that they can meet for manufacturing. So I think it's get on the program and try and get as comfortable as you can in areas in which you are competent and able to do your diligence.
Yeah, I agree with that. And also it's access to patients. Just the speed of the clinical study.
Great point.
Just incredible, isn't it? Yeah, it's really fabulous.
One of the points that we've seen emerging in the U.S. at least is on the pharma side, or in the sector, I guess. The tariffs that seem to be being applied, can be affected by your investments in manufacturing in the U.S., et cetera, which I think the bigger companies have been able to kind of step up and meet and make commitments that make their lives easier. But what does that mean for the smaller companies that are relying on, CDMOs or the WuXis of the world? How is this going to have a bigger issue down the road for those companies?
I can say something here. So we have a case in our portfolio of a company that they are indeed, in the short term, they continue with the CDMOs that are outside of the US, but in the midterm, they are already thinking of moving CMC into the US. So it's something the companies are considering, to incorporate.
We've seen it on the M&A side, in that I would say there's increased vigilance on your manufacturing strategy, being part of the early stage discussions on partnering and on M&A. So I think having multiple approaches to your manufacturing is appropriate. The big companies who have the capacity to onboard and integrate it into their strategy are much better placed. But we're often looking for people who maybe want to buy a phase 3 market nearly ready in an area they're not used to, and they're probably a little bit more skeptical about their ability to take on board a manufacturing program. So I think the more US plain vanilla, non-controversial you can make it, the more that will go down the list in terms of points to be negotiated on an M&A transaction.
Interesting. Any questions? Okay. One of the other things we were talking about, we're seeing what looks like the venture capital spigot being opened again after having been, a relatively tough time. We have 3 very experienced venture capitalists sitting here at the moment. Are you seeing a change in terms of receptivity or how you're viewing the world with the market improving?
Shall I? Yes, I think things are much more positive, actually. I think one of the things that we're seeing, and a lot of companies that we invest in don't get visibility on this, but is our LP base, so the people who give us money. And they're massively risk off. So venture is like, no, I don't want to do that. And that's partly driven a lot by the interest rates, because they can invest in debt and sort of median out, get similar returns on debt.
Or gold.
Or gold. Yeah, exactly. It's like, why would they do venture when they could do something very safe like gold? And so I think what we're seeing now, as the interest rates come down, people are going, where can I get those higher returns? And so they're coming back to venture. And so fundraising for funds has been incredibly difficult over the last 2 to 3 years. And I do see a softening of that for sure in the LP base. And then, so as funds get more confident they can do their next raise, even with terrific track records, they can do their next raise, they're more confident about investing in companies and bringing in new companies rather than saving their capital for their existing portfolio. So that's really unlocking the spigot for people that is going on behind the scenes, I think, in every venture fund that's out there. So we're pretty excited about the future. We're in a very fortunate place, is that we've got a lot of capital to invest. We're actively looking for deals in that clinical space with a 20 million to 50 million ticket. And so we're really actively out there. And it's a great time to invest, actually. Just hope we can get in early enough before the wave of capital hits the wall.
Maybe I can add on that. What we see in the VC fundraising space, so really for VC fund managers, it's a challenging environment, as Allan said. It's quite polarized between people who can count on, LPs coming back, very strong LP base, and other fund managers who have more difficulties. All the more so as there was a lot of money put in the market in 2020, 2021, and these funds have already finished or are due to finish their investment period very, very soon. So in order for the fund manager to keep in the market and continue investing in startups and not just do follow-on, then they need a new fund. And for such fund managers, it's very difficult because a lot of private investors are not active anymore in the space. What we see typically are public investors or corporates, but in terms of, like the asset managers, the banks, the fund of funds, they're not that active in our market. So it is very challenging for the fund managers these days.
With respect to the EIF, I think they need to be acknowledged as well, and groups like BPI, for the amount of larger funds that are now, rather than talk about gloom. If we look at 2019, there were very few funds of scale able to do follow-on investing and create that market. So if you think of Ferbion, EQT, Kurma, Andera, there are now significant number of funds who can dedicate growth rounds, which was traditionally where the US came in and, stole our dinner. So I think that the ecosystem is beginning, it can always get better, but at least this time around, with the backing of some of the more experienced LPs, we have much more of an ecosystem to chase that dragon a bit more. And hopefully those funds will then make a return and create a more evergreen environment for follow-on capital, which was a structural fault for many years in the last period where we had good M&A.
Yeah, exactly. That was one of the segment of the market that we have seen facing difficulties for years. So the 500 million plus fund, even the 1 billion plus, which was completely lacking in Europe. And we had a specific programs that were targeting these funds. So this 1 billion plus, and on top, we really try to put funds that were over 500 million in the market. So that was one of the funding gaps that we have really tried to address these past few years. And also on the other end of the spectrum, everything related to tech transfer and really going from research to companies. That was a second fundraising gap that we tried to address.
Nothing else yet from the audience? Okay. Oh, sorry.
Maybe I can give a different view. HVM is an evergreen vehicle, so we don't face these fundraising difficulties. So I can give the view of what happens internally. So as the IPO window is closed, then we investors, we need to preserve cash for our existing portfolio companies and support them in the upcoming financing because they won't have possibilities to fundraise publicly. So this forces the investor to also make less new investments. So we are really hopeful now with the lowering of the interest rates and the high M&A activity that the IPO window will be slowly opening up with a lot of private companies that are mature now. Most probably they have a lot of good assets to offer to the public markets, hopefully in the next year.
Just one, I think that's a really important point actually, because the other thing that we're seeing now, particularly in a number of US investors, is they're split between privates and publics. And a lot of the US funds now that we're seeing are very much focused on the public market, where there are some great opportunities and some really good opportunities to invest and get that uplift very quickly, versus the private market where you hold for longer and everybody's holding out on their valuations, whereas in the public market, the price is what the price is. And so that's got to unfreeze as well a little bit in the private market, I think, to really get the capital flowing. And that's helped by what we were seeing here, where less companies that are underwater on their valuations. So I think that's got to move. But I'm pretty confident 2026 is going to be a great year. We're coming back.
Yeah, just on that, it's true that in Europe, we are lacking what is called crossover funds. So funds that are able to invest just pre-IPO and continue investing post-IPO. So the market is more fragmented between private and public capital in terms of strategy. So it's really something that we would want to see more, these funds that can, be there just before and after IPO. And it's one of the strategy we want to develop in the coming years, and with the Commission also wanting to address this concern.
Be careful, Alan. I was told yesterday by my friend Laura, who's not here, to double down, that I was talking about green shoots in the sector. And then 2 days later, the Silicon Valley Bank kind of went under. So I hope you're not a harbinger of anything like that. But
No.
One of the interesting things, of course, is, as you said, as those numbers of companies with negative enterprise values continues to dwindle, the opportunity to get really good returns in the public market disappears or dwindles. But I've made this beautiful list of Sidara and Unicure and Soleno, all three companies which were in negative enterprise value 2-3 years, a year and a half ago. And I mean, the returns are enormous, right? In a year and a half. If you work that out, but you have to kiss a lot of frogs to get some of those princes, unfortunately.
Thanks a lot. Hello, everybody. So when you talk about the private market and the capital, wouldn't you say that the investments is pretty weak because there haven't been any type of returns in the recent years? Meaning that I spoken with a family office yesterday, and he told me there was a guy, first fund, he opened the fund, of course, great returns on paper, never exits. And then he wanted to open a second fund before closing the first fund. And that would mean for sure that they will keep on the bad companies as the fund closes. And therefore, everybody in his family office said, hey, why don't you double down on this fund, on the second fund? But he said, look at the end returns because no money is being returned. So wouldn't you say maybe that the reason why private capital now is kind of weak is because there are great returns on paper, but they don't give exits to the mutual funds or to the huge sovereign wealth funds? That's just a question in a way.
If I may on that, when we look at, because we've got such an exposure that we can really have a view on performance of this specific segment of the market, there are strong returns. When we look at funds, we have very strong performance on some of the funds that we invest in. And it's not just only on the big names, also on smaller fund managers. What is true is in terms of timing, it takes more time. like the fund duration, the time it takes to create value is longer than in other segment of the VC market. So there's this timing element, and when manager goes back to the market, typically for their previous fund, there is no exit. There can be some inflection point in terms of value, but still it will be still much early on in terms of value creation. So it's true that for private investors who are solely driven by performance, assessing also the performance and taking an educated guess is difficult. So it's something that we in EIF we're well aware. We try to entice other LPs joining us in this space, but not educating other LPs, but at least trying to share our experience through reference calls, through different means. We've also put our benchmark available for other private institutions to look at and have a view on what should be expected for different fund vintage in terms of performance. But it is an inherent issue in the market that performance takes longer than in the more tech-oriented VC market.
As a private VC at the investment committee, we have to know what our business is, and returning capital is actually our business. So we make a lot of our investment decisions based around returning capital to our LPs. So a certain amount of the answer to your question is, who are your fund managers and what drives them? Because you will get the performance based on what their priorities are. What I will note since we first started investing is our holding periods are a lot longer, somewhat because of all these macroeconomic factors, and because of COVID, a lot of our clinical programs experienced a sort of a 12 to 18 month slowed down, all of which had to be funded within the companies. So reserves, it wasn't just the market dynamics. I think it's that the actual value creation had this sort of lag that's only beginning to wash out. So for us, in the private side, it's generally 5 years to invest, 5 years to recoup. But generally, a lot of our investments, you get about a third of your portfolio perform within that, about a third go longer than that, and about a third, possibly you need to cut the cord and actually make decisions about allocating capital to the most worthy investments where you think you'll get a return. So for me, it's all about how managers run their money in order to justify new LPs seeing their track record, not just on their existing investments and return, but the direction of travel of their investments and the likelihood of them to give them a return.
I just had one point. I was interested in Cindy's details, because there's some data come out of the British Business Bank, actually, who've got a portfolio of tech and life sciences, and they've actually shown that life sciences repays capital much faster than the tech. So the valuations are higher. So you've got all these unicorns that all these tech entrepreneurs talk about, but they haven't actually returned any of it. Whereas actually in the life sciences space, you actually get better returns. And that's not what the classical family office actually believe. They like tech because they can understand it better. Well, they think they can understand it better. Whereas life science is all too complicated with molecules and cells and cytokines and stuff and T cells. And they don't like that but actually the life sciences gives you better returns and faster. And that's data from the British Business Bank across their LP base, which is about to be published, actually, I believe.
Allan, for us as well, we also have the contingent payments.
Yes.
In tech, it's very much an upfront exit, whereas an awful lot of we have these long possible revenue streams which are monetizable by many other people as well. So, assuming it's a product that's going well, and we have a few of those that we're hoping will go very well, they are a continued source of revenue and return. So the return period is actually long, but it can be extremely lucrative for our investors.
So who's responsible for, I don't like this phrase, I think you used it and then you thought, I'll put educating, because it sounds like they're uneducated. That's not true, right? Who's responsible for helping go around this group, of course we can't because we've got day jobs, and meeting all the big family offices who, for example, right, who have the big money, and showing them actually, if there was a time to start thinking about this properly, is now. Because tech valuations are sky high, helped by some nice circular deals. And XAI apparently just raised 20 billion yesterday. So I didn't read the detail of what valuation. So how do we execute this?
We see that as part of our mission, really. So when EIF invests in a fund, we want, and to use our own internal jargon, to be catalytic. So to make sure that we bring on board other investors just by their trust in our due diligence and with, as I said, giving reference call, participating to conferences that are more LP focused to make sure that they are aware of what we do, how we do it, and what kind of what in the overall VC and private equity segment can be interesting for a private LP perspective. So this is really something that we see as a core of our mission.
There is some moves afoot, Stan, I think, at Europa Bio and the BIA, who are working pretty heavily on terms of just raising the profile of the returns that are possible in this sector. Yeah, but I think all of us could do more and get educated ourselves to go out and be evangelists for life sciences. Yeah.
Okay, any other questions? Or I have, oh, there we go.
So good morning. I'm Seth Goldblum from Colgan. So Stephanie, great presentation, loved it. Panelists, great insight. So, you know, it's great to hear that the biotech industry, pharma industry is finally coming around after so many horrible years. But let's face it, when you look at high tech, they have AI, and those returns have been amazing. When you look at fintech, returns there from crypto, amazing. Biotech hasn't really, although it's turned around, hasn't really been there. What's it going to take to get biotech to get those kinds of returns?
You have to buy the right stocks. But that was the whole point of, I think, what we were trying to convey in that, I mean, no sector, right? Okay, let's go back to 2000. How long did it take for the dot-com bubble after it burst for people to start trusting that it's worthwhile investing in tech again? 5 years. When I equaled the performance of the NASDAQ 100 and the tech sector back then to what's going to happen to biotech this time, some people thought I was crazy. And I think that's what we've just been through. So now you have a choice. Do you keep investing in AI type things and fintech, or do you start diversifying? Your decision will be made based on where are the relative valuations? Where is the relative valuation played today? Now, of course, we sit here. We don't, we're like turkeys not waiting for Christmas, right? We don't want Christmas to ever come. And at the end of the day, of course, we would talk up our own sector. But I'm not a banker. I'm not an investor. I'm an observer and I do the analysis. So I don't have any axe to grind on that front. I can see the possibility that we're going to have a situation where you might see a reversal in that trend. Now, what's of course interesting is that a great AI play, anybody want to tell me one? Caterpillar. What do they make? Old style gas engines, right? Look at their share price chart. You don't have to go to AI to be making money. You can do old industry, and you have to keep finding all the tendrils of AI making it into these older industries. Old style gas turbines are the quickest to get today. So they've got a massive order backlog or order book. So there are other ways to invest. There have been other ways, but a lot of that is playing out or has played out. The question is, what do you decide to do now? Do you call it and then move some money into healthcare and biotech, which, by the way, is one of the two areas in the US where there is positive employment, growth. Healthcare was one of the key ones. What's that about? Well, we all know it's the demographics that are driving it. So
we're out of time. We're past time, actually. So I'd like to thank the panel and hand back over for the next group.